Thanks everyone for joining us today. My name is Mike McCormick, and I'm a senior manager in the audit practice at KPMG, and I specialize on technology and venture capital-backed companies. So I think we have a really great panel for you guys here today. So let's start by bringing our panel up here and doing a brief introduction. I think we're waiting on one of our panelists, but we can go ahead and get started anyways. So why don't we start? Ezra, why don't you kick us off? Brief introduction about yourself.
Hi, I'm Ezra. I work with Ackrell Capital, a boutique investment bank. We advise on mid-market technology, M&A transactions and financings. And great to be here. I'm excited to talk about the topic. I have a copious amount of research on this post-it note that if you turn it this way, actually has the entire Crunchbase database in it. So.
Michael Neril, I run Web Investment Network, a seed fund focused largely on enterprise and cloud. Pleasure to be here.
Hi, I'm Todd Francis with Shasta Ventures. We focus on Series A investing and some Series B, and we focus in consumer and the enterprise across kind of mobile, internet, and the connected devices.
Hi, I'm Padma, and I'm an advisor for Bullpen, as well as being on the board of Julep, and I'm an advisor for a bunch of other companies as well.
Great. Sounds like a great group. So let's kick things off with starting on the topic of the Series A crunch, and if you believe there is a Series A crunch, or if the current market is the new norm.
I don't mind jumping in here. I think it's all about how you define the word crunch. So if crunch is defined by all the seed companies, are all the seed companies going to get funded in Series A? Absolutely not. But there is definitely capital out there for Series A rounds if you have, and it typically falls into two categories. Companies that are exhibiting strong momentum or some element of momentum with their seed dollars, or a very compelling founder with a vision that you just believe in. But we see Series A companies that are getting funded very rapidly at healthy prices when those things are in line. And yet companies that aren't, don't have that kind of momentum and some of those characteristics are going to have a harder time raising capital. So I think the crunch part came from when it was easier to raise Series A. There were, several years ago, maybe before the Facebook IPO, when the business models were a little looser, it was just a lot easier to raise the Series A dollars. And now the market has tightened up and is looking for more proof. And then the last piece I think that feeds into is there's more seed dollars. The seed rounds are getting larger, so there's an expectation of the companies being a bit further along. Mm-hmm. So I think it's really about expectation, but there's definitely capital out there for a good Series A round.
Yeah, I mean, my research, I went online today and did the analysis. And early stage, which is defined as product service may be commercially available, may or may not be generating revenues, was the stage. 2009 for that stage, 4.9 billion. 2010, 5.9 billion. 2011, 8.8 billion of VC, and 2012, 8 billion. So, in fact, we're awash with Series A capital. In 2012, of the 8 billion, there was 1,700 deals. 4.8 million was the average deal size. So we've almost doubled in the last 3 years. So I think, to Todd's point, the crunch, I think, implies that there's a demand side problem. There's not enough money. I think the problem is the massive proliferation of companies trying to get that money. And so I think that's the topic that's the interesting part. The crunch, it's almost like a crunch to the door versus being no room to go to.
So I was just gonna say, I think that's a great point. My only other last data point would be, I looked at an interesting report a few months ago from CB Insights. There's a lot of other reports, data, but looking at 2009, 2010, there's effectively 3 times the number of seed companies have raised startup capital, as defined as up to a 1.5 million raise, while the number of deals on the A front has really only increased very, very modestly, about 3% a year. So therein lies the kind of supply-demand imbalance as well.
So with this massive number of seed companies that you're seeing,
well, we got Matt coming up here, so we'll make
Matt,
room.
come on.
I hope you got, yeah, we'll stuff.
Yeah, we got the booster seat.
This is the crunch.
So Matt's a little late to the party, but we'll let him quickly introduce himself.
Yeah.
Howdy, Matt Ocko, co-founder, managing partner of Data Collective. Long time as an entrepreneur, long time as an investor. Relevant stats. Do stuff that's very hard, very deep tech, most other people don't like. Contrarian investor, 220 deals over the last 20 years with my colleagues, fewer than 25 losses, $30 billion in returns for entrepreneurs. That's who I am.
Sweet.
All right. So with the massive number of seed companies that we're seeing out there, what are some recommendations you can make in terms of key metrics investors focus on or ways that companies can distinguish themselves in the competitive market for raising Series A?
I think one of the key things is that, I said this when we had a discussion prior to doing this panel, that for a lot of the companies I advise and a lot of the entrepreneurs I meet, they don't spend a lot of time warming up their investors in advance to get to know them, to see if they're a good fit, to see, to actually build the confidence and the trust over time, so that, I keep using the analogy of being the prettiest girl at prom, having your cap table cleaned up, having your metrics in place, them knowing you personally to know if you're a good leader and an entrepreneur that they want to invest in.
Yeah.
Go ahead.
Well, I'd agree with that. I think it's really about the expectation of what the fundraiser is going to be like. We see a lot of blogs and discussions and posts about, hey, don't let those venture guys take more than 2 days to make the decision, or all this kind of this expectation that it's going to be easy to raise capital. But if you flip that around and say, hey, this is a really important round. I'm setting the table with my investors who are going to be with me for 5 to 10 years. I'm going to take time to build the relationships and do that. I think that can yield a different result. That you realize it's going to take a little bit of time. They're going to want to see some information, want to see some data, see momentum, and have a little bit of time to make the decision. I think if an entrepreneur goes into the process with that mindset, it's much more likely to be successful.
Yeah, I think Todd makes an excellent point that I'd like to amplify on. I'm not going to name names, but I have seen an endless profusion of articles advocating a very Darwinian approach to raising capital. VCs are stupid and greedy and bad, and take them for whatever you can as fast as humanly possible. Your 2-day limit is awesome. I wish I could get that. Get it done in 24 hours, or they're incapable of making a decision. And as with everything in life, you eventually get out what you put into it. So if you start with an adversarial relationship in your seed, unless you are killing it, and statistically, not everybody kills it. There is such a thing as a really good, but still from external appearances kind of mediocre company. You'll have an adversarial relationship with your existing investors, and the other guys coming in will have heard about the behavior and probably not be the nicest people. And that will go on through successive rounds. It's easy to mythologize and demonize on both sides, and I think the biggest thing that I can encourage in terms of having a seamless and less stressful series of financing events is get to know the people that you want to invest in you. Think about who they are as people, think about their firm's culture, make sure that your culture is a thoughtful and productive and cooperative one as opposed to adversarial, and you'll have a better outcome. I mean, Todd's been at this as long, if not longer, than I have, and I think one of the things that I've observed is big wins take 10 years. I mean, Google's an 8 or 9 year overnight success story. Ditto for Facebook. That was actually a fairly long run before they were able to monetize. Cisco didn't reach the peak of its market cap or really reach fruition for 10 or 11 years. So you have to think in this time scale and plan to have a positive relationship with the people that you're asking to support you.
My only comment, I think that's a great point, Matt, is you're building a partnership, and communication and transparency is also, I found, to be really, really important. Not only when you're actually looking to bring in your partners or your new investors, but also throughout the process. Quarterly, monthly investor updates. Like, we've invested in about 55 companies. We certainly don't, require they run the show, but having some type of quarterly communication or sense of update also helps when you actually go to raise your next round.
I guess my alternative view would be, given that your enemy is not the venture capitalist, your enemy is the entrepreneur sitting left and right of you, because there's so much competition, that think about options. Is your only option to raise a Series A? Do you need $5 million in cash? And if you're designing a business plan, you're quitting your job, you're putting years of effort into this thing, you're not making any money, you're sitting in an incubator, is the only strategy that you're optimizing for, the only option you're optimizing for, a business that requires $5 million in cash to basically get to the next level? I know lots of great entrepreneurs who've done it on very small amounts of money, but just had an idea that was incredibly capital efficient. And so I would understand that and not completely buy into the notion that the only second turn in your business is to raise a substantial amount of cash to fund it. I think sometimes that is the only option, but it's not always the only option. And I would spread those options out a little bit more.
So that's a good point. What if you're a company considering an M&A route? What advice would you give to them that differs from that of a company looking to go for a Series A?
I would take Padma's advice and just change the word VC investor with strategic and say, get to know them early, develop relationships, do BD deals, become their friend, get dependencies. A lot of deals are done, in the abstract, but a lot of deals are done because there's a tight dependency or integration between the two companies, or someone else sees that tight dependency and correlates it into their world. And so the more that you can basically be part of that ecosystem, the better off you'll be. But at the end of the day, you have to be doing something novel and innovative. You don't necessarily have to be losing tons of money.
I would actually broadly echo that. What I would say is all of us, VCs, entrepreneurs, M&A guys, see something else that happened, and we say, how the heck did that happen? My thing is shinier, bigger, better, faster. Those guys didn't deserve that. I mean, we all suffer this odd mix of jealousy and incomprehension from time to time, because we're all competitive people that like building stuff and want the things that we build to win and receive recognition. So how does that happen? Well, to the point that was just made, a lot of it has to do with relationships and goodwill. I mean, there's a reason that acquisition accounting has the term goodwill. These personal connections and personal trust are incredibly important. So if you want to switch VC with M&A, you really need to start the moment that your technology is relevant to an acquirer, and make sure that at least one of the acquirers in the space is either dependent or intensely enamored of your tech, and the two others, or three others, or four others, know about you, respect you, like you, you've been helpful, you went out of your way when you didn't have to for somebody in some giant corporation that needed help, and you'll be the person that's featured in TechCrunch that causes everybody else to gnash their teeth. That being said, there are some hard metrics. I mean, increasingly, major corporations do not do stuff that is not accretive. For every whizzy Instagram, and God bless those guys for pulling it off, there are the bones of 10,000 wannabes littering the elephant graveyard of startups that thought that they didn't have to be profitable and didn't have to represent accretive revenue to their acquirer. So keeping a really beady eye on whether you're actually making money for somebody is incredibly important.
Yeah, since we're talking about acquisitions, I'll dive into maybe something that's a little more sensitive and may not be perceived as desirable, which would be an acqui-hire. I'm not saying that's why you set out to do anything, but let's say you get a company up and going, it's hard to raise the capital, you aren't accretive, it's not strategic. There are still other options where your team or your vision or your concept may be really well suited to another platform, and that you can build something of significance and be part of a great company it's just a little bit different than what you expected. So I'm not saying that's what you should set out to do, but I keep an open mind to that, because I've seen some people get acquired into Facebook or some great companies and do really well and become significant players at those companies. And there's lots of ways to do that. I think a lot of the things that have already been discussed is be important in your category, get to know the key players. And now there's new platforms like, I don't know if you've heard about Exit Round, but it's a platform to help connect corporate M&A groups with entrepreneurs in an anonymous basis. So you can kind of say, hey, here's kind of what we have, is it of interest? And you can do a little bit of blind dating that way.
Hiring with friends.
Yeah. So it's kind of interesting, and you work with different kinds of groups. So there's I think more options today as things move on.
Okay.
Yeah.
Another thing I wanted to touch on was the expectation from an investor standpoint, depending on the stage of the company. I know that from an investor standpoint, you're going to be looking at different things for a company looking to raise their Series A compared to a company in their Series C. Can you guys talk a little bit about what you look for, what you see out in the market?
We like at least 3 napkin drawings. Only 2 we're not investing. No, actually, I wanted to follow up on an earlier point, which is part of making sure that you get your Series A done has tremendous dependence on everything that you did before. I know that Michael and his team in their careers have done disruptive stuff, and we're co-investors in some stuff that we believe is very disruptive. I know Todd in his prior career did things, especially in the networking space, that a lot of people didn't think were possible. Me Tooism is a good way to not get a Series A done. Fluffiness is a good way not to get a Series A done. If you're the 19th menu optimization app, the 15th food delivery app, the 74th human resources improvement enterprise deal, you will probably die. You may be very brilliant, you may have great stuff, you may have hired a good team and great designers, you will probably die. Statistically, you will die. It's like restaurants. Some crazy number, like 990 out of 1,000 new restaurants die. It's true for startups, acqui-hires notwithstanding. Do something really freaking hard. Go reread Peter Thiel ranting and raving about a lack of innovation in Silicon Valley and get inspired by that. And it doesn't have to be building a rocket or out-glamorizing Elon Musk. It just has to be something that nobody else is doing that offers really crazy value to a core constituency that has to have it. And so in terms of risk, if you show up in Todd's office or my office or Michael's and say, hey, I'm doing X, you might still have an insane amount of risk in your company. But if it's highly differentiated, you're more likely to get a Series A done even if you have Series Seed type risk. If you show up even Series Seed and people realize that you're already facing 14 different competitors, you're much less likely to get funded. And if you do get funded, you've geometrically reduced your likelihood of funding all the way through the other stages. So, sorry about that, just wanted to.
Oh, no.
I actually think that answered your question.
That would be good.
That actually was it. No, that was in many ways the answer to the original question. Yeah.
I was just going to say, building on Matt's point, most of what we do and focus on is the enterprise, and what we've been seeing in terms of profiles of successful seed investments we've made that are going on to raise an A round of 4, 6, 8, 10 million, which is kind of the new B round, with some anomalies, of course, but typically, obviously, clear product market fit, monthly recurring revenue of plus or minus 150K or 2 million annual run rate, with a clear path to proving out, building a sales model, and adding additional heads to get the revenue from, call it 2 million revenue run rate to 10. So clear customer traction, having some paid pilots, obviously. There's been a few. Their team has built great community. They don't have customers or revenue, but that's kind of been the sandbox. And Matt, you probably have some color as well as.
Just before Dodd dives in, what I would say is incredible tech and rabid customer interest / dependency are fungible with traction. So, I mean, nobody up here is an idiot. If you show up with something entirely undifferentiated, and you manage to be doing $20 million a month, probably at a 10 million pre, that's pretty interesting. I'm being almost entirely facetious. But these things really do trade off. There's no formula for them. But by way of example, I had a bunch of guys that wanted to talk to me that believe that they can massively optimize the way that gasoline is moved around in the middle of the night between independent stations. Sounds stupid, but turns out it's a $4 billion a year expense. These guys are all screwed. The refineries hate it. The people that they've pitched to say, I will sacrifice my neighbors on an altar of fire to get this optimization. These guys aren't making any money. They already took some seed funding. That's such a deep vertical with so much dependency by the customer, that's interesting for an A. To Michael's point, if somebody showed up with, $4 million doing something less vertical or a little fuzzier, then that's where the trade-off happens.
Yeah, I think some of the key elements of an A round, they fall into thinking kind of two main buckets. One is indication of customer interest or traction. That doesn't mean millions and millions of people, depending upon the stage of the company, how much you raise in your seed, but it's some indication that the customer life cycle can be viewed. People, you can acquire a customer, they want the product, they use the product, and they refer it, or somehow there's a repeat purchase component to it. That kind of data is very compelling. The second bucket is a very compelling team, a team that you just believe in. And maybe they don't have as much proof, but they have experience, or that you just connect with them and you believe in the vision of the team. It's almost like a continuum. The more compelling the team, maybe the less data you need to get comfortable. Or said differently, let's say the team doesn't have experience, and a lot of great companies are built with teams that don't have prior experience, but they show product market fit at some level. It's like, well, you can get on board with that. If you don't have either of those, then then I think you're in no man's land. That's where it's really tough.
I would also, just from our client experiences, the other piece of the puzzle is just being in a style and category of company that venture capitalists find attractive. To your prettiest girl at the prom, I think that if you don't have things pretty cleaned up, if it's not a clean deal, if it's not in a category people find interesting, we did a deal recently where we're actually going to go most likely an M&A route with it, and we talked to a bunch of Sand Hill Road VCs on behalf of our client, with our client, and the reality was it was just a couple clicks off of the traditional VC deal. So I think you have to be in a very style of company, style of deal built for that kind of rapid scale that has incredibly cost-efficient structure, and that actually is not an easy hurdle to get over. That's actually if you're not born with that, it's hard to sort of become that.
This morning I was talking to a friend of mine about the team aspect of it, because my perception, my feeling in general is that at the Series A, there's still a lot of volatility and there's still a lot of risk. And so getting to know the team and the founders and all those things, you still have a really high dependency on their decision making and their ability to execute on this still. And so I think over the course of the last 2 years, as I've been doing diligence for Matt and Bullpen and others, I think I underestimated, and I'm only coming into my own mindset about this, of how little is under my own control, and how I'm looking at such a point in time of information, and there's still so much more that's out of my control and is going to be in the control of these people who I'm handing money to. And so it's just reiterating what Todd said.
I actually think in many ways, though, it's also the opposite. I've been on the entrepreneur side as well, that in many ways, once you take the money and you commit to a plan, you had better be darn ready to scale, because you are now locked into a strategy that you need to execute upon, and you've convinced a lot of people there's a lot of stuff that's going to happen now, and if you don't believe that and you're taking the money because you need it, that is a recipe for a recap. So it's a great way to lose your company.
One quick point on that front too, raising a massive A round, like in some respects maybe you're raising your A and B at the same time, and at a 40 million post where the metrics are still very, very early. I I've seen some opportunities, some instances where there's clear merits, but I'd be sensitive to, valuations are obviously illiquid. It's relative funny money, if you will. So, to Mike's point, if you raise a large round at a really, really high, pre or post, and you don't grow into the metrics, obviously things aren't going to look so rosy. And we've had a couple instances where the entrepreneur has, raised really large rounds at very, very high kind of illiquid valuations, hasn't grown into the metrics. They were 12 or 18 months ahead of the market. And to Mike's point, recap. Matt and Todd.
Money is a millstone around your neck. It carries a huge number of invisible obligations associated with it. You better be damn well prepared to use that money intelligently and at the same time plan on a huge reserve. So I think Michael is dead on. What I was going to say is I think Todd elucidated something important that I was getting at, which is I was getting at less coherently than he did. A lot of the A actually does in some ways tie back to what we talked about before. It's faith and goodwill. So a baller team is a chit that buys you faith, that buys the investors faith in doing the A. Traction is a token for faith that the team, regardless of how impressive their credentials or lack thereof, has in fact executed. That's generative of faith. And deep, dark, amazing tech or client relationships, some sort of incredible proprietary advantage that's resonating emotionally with customers in the field, regardless of traction, buys faith. So there's really kind of an iron triangle, if you will. And you can slide the points around, but all three of those things have to be present to some degree. And you can have one of them hypertrophied. So if Todd and Padma and Michael walk off this panel and quit their day jobs and ask me to participate in an A round, I would probably say yes, independent of what they were doing. And you can have somebody that has insane traction and nothing else. Snapchat being a good example thereof. Great guys, not super deep tech and no real proprietary advantage, and very, very bright guys, but not a team that's done it before. But these examples of hypertrophying, of being way far out along one of those points of the triangle are rare. Really what I ask most entrepreneurs to do is optimize all three the best that they possibly can and make a virtue out of weakness where it's necessary.
Mm-hmm.
I did want to say that we're going to save a little time at the end for questions. So if you have any questions, we'll save 5 or 10 minutes just to put that out there. Let's talk about the valuation a little bit. You guys have made reference to that numerous times. You're a company thinking about raising Series A. From an investor standpoint, what are you thinking about when you're looking at the valuations?
I think you had a great point on the call about valuation, but oversized.
Oh, that it basically, I made a comment about how people are always going for the maximum valuation they can get, even though they may not have grown into it. Isn't that the thing? And then the point is that nobody wants a down round. So you've set the expectation that you're going to do better next time. And so if you're not even there yet, up to like the trajectories and the plans that you've put out, if you don't hit them, there's no wiggle room basically left. And so it's not always in your best interest to optimize for the highest valuation, because you know your business better than the VCs know your business actually too, right? So that was the
yeah. I mean, I agree. I think all things exist in equilibrium. I read I thought it was a funny article in 2008 on Vator when everything was like going bad, and my friends were calling me up saying, "What do I do? I got no leverage. What do I do? What do I do?" And I said, "Look, the reality is, investing is a part of an equilibrium, and most of the hairy terms in the financing come from overreaching on valuation. If you don't want ratchets and you don't want participating preferred and you don't want redemption rights and 20 other things that can go into a financing round, then find a reasonable valuation where everybody's going to make money." And I think entrepreneurs get in this weird kind of like feeding frenzy mode where they believe that all of a sudden the VC is their enemy in that process. And and they need to get the best possible deal at the highest possible return. That's not true. That's actually someone who's going to be on the same team with you over a long period of time, helping you build your business. You want them to make a lot of money on that investment. So find a round that's going to be very team building for everybody and makes everybody a lot of money, not just, hey, I can really stick it to them this time around. I think that's a bad plan. I think you should be really thinking, particularly in Series A, which is so early, you should be thinking about who they are, what their reputations are they going to be supportive of you, do they have good networks? All investors are not created equal. So I think it's such a multivariate equation. It's not just about the value.
So I think those are awesome points. One of the most interesting statistics, and we're big data and deep compute investors. We'd be kind of hypocritical if we didn't apply that to our own business. One of the most interesting statistics that we found in the venture business, looking at successful deals literally over the last 40 years. I mean, going all the way back to the days of DEC when it was starting, is that tremendous, long-lasting franchises rarely took, and when I say rarely, I mean single-digit percentage points, rarely took the highest venture investment offer that they had. The folks who have built gigantic, durable franchises picked based on personality. Could they work for the next 7, 10, 20 years with the people whose money they were accepting? To Ezra's point, value of network, expertise. Maybe you don't want your VC doing a code review, but you certainly, if you're doing a technical company, Big Bob, Snortlewick pulling up in his Bentley on his phone going, "Are we rich yet?" Is probably not the guy that you want, no matter how good an enterprise salesman he is or isn't. Most folks forget this. And again, there's been a disturbing swing towards this kind of adversarial behavior. And as sure as it is now summer, but it will also be winter very soon, nothing is forever. If you live through the booms and busts, I know Todd, you had a long career like mine. VC had a flowering in the 1970s that was crushed out in the early 80s with the collapse of the PC industry. There was a mini collapse in the networking business in the late 80s. There was a recession of the early 90s. Over and over and over again, when people say, "Oh, everything's changed," and literally we can be jerks, and it doesn't matter which side, whether the VCs are being jerks or the entrepreneurs are being jerks, there's a price to be paid down the road. So pick based on goodwill, personality match, skill, network, value add. Think about the fact you're literally going to be in bed with this person for the next 20 years if you're building an enduring franchise, and don't be a jerk. Dial in a valuation that lets everybody make money, and you are much more likely to get your round done.
The only thing I'd add on this is I encourage entrepreneurs to think about valuation kind of by stage. So your seed round is typically a person with a vision, and you're trying to cobble together some money to get going. Most of the seed investors aren't as active. They typically are friends or industry folks. When you go to the A round, you are choosing a partner sitting at the boardroom, at the board table for 5 to 7 to 10 years. I always think of it as setting the table. Choose people you want to build a business with. As you go to the next stages, that's where I think you want to play valuation. Yeah. The B, the C, the D, because the people are not going to be as involved, especially in that kind of that C round. And so think about raising the amount of capital in each round to get you to the next stage, where that next stage is a really healthy uptick for your current investors and for you. And then you can raise more money at the next round at a higher valuation. Think about each round kind of jumping up the stairs that way versus trying to get it all in the A round. Because sometimes that may not work out. You may either end up at the wrong price or the wrong partner. So I always encourage kind of an escalating thought process on this.
Yeah, I have, to your point, Todd, I have 3 companies that in the last 90 days went from very constrained, very sort of conservative seed and A rounds. I mean, where the A rounds were in the low teens, let alone the seed, which had been much lower than that. And each of these three companies has now raised a substantial amount of money, well north of $100 million. And lest you think that this is kind of a backdoor way for me to blow my own horn, in 2 out of those 3 companies, I was just a fortunate, smaller investor through a variety of circumstances, so I don't claim any credit for that. But the folks that the entrepreneurs picked added so much value, to Todd's point, that they were able to raise a much larger amount of money from less differentiated investors when the time was right. So greed does not pay, I think, is the message.
No, that's right.
All right, we're wrapping things up here. We have time for one question from the audience, if there's one. Yes, in the back corner.
What do you look when you are investing into a first-time entrepreneur and he's raising his Series A round?
Where do you put your personal money, Padma?
Do I have any? I think it comes back to, especially, to Matt's point, you're triangulating. It's easy to look at a high-class resume, and you could use that as a data point. But if it's a first time, you have nothing to go on. So the getting to know you again and watching them through the process, there's just no substitute, honestly, because otherwise I don't know what to base my decision making on. And I'm probably newer to this than any of these guys. And it's been a hard lesson for me, honestly, to understand that, again, I'm looking at a point in time, and especially with the first time, there's no reference point for me to say that you have the ability to execute on this. And so getting to know you over time is really my answer to everything, I guess.
Yeah, I think it's a great question. It used to be we look for people who've done it before, been in the industry, boom, boom, boom. Now it's totally different. Technology is changing everything, people's ability to make progress. What I look for is the intensity of the entrepreneur and their vision of the customer need. Are they seeing something that nobody else is seeing? It may be kind of a crazy idea, but do they see something others aren't seeing, and do they have an intensity about it? Not just like, oh, I'm going to work all day and all night, but an understanding of what that customer wants and needs and has a drive to get there, because this stuff is really hard. And if you don't have that, if you don't have raw intellect and intellectual horsepower to dodge and weave as all these challenges come along, it's going to get hard. So we look for, it's not a resume, it's not a school background, it's not even a company background. It's kind of somebody who sees something with an intense passion, sees it differently, and very importantly, we think can recruit a good team.
Yeah.
Because if you're just an individual crazy man, it's probably hard to build a team. But if you can be that and build a team, that's an awesome combination.
All right, I think we're out of time here. But thank you very much to the panel.